Where does money come from? Is it printed by governments, minted from precious metals, or simply conjured from thin air? While many of us imagine a grand treasury printing press, the truth is far more intricate and surprising. Most of the money that circulates in our modern economy isn't created by a government at all. It is born within the complex, interconnected machinery of the private banking system. The story of money creation is not one of ink and paper, but of loans, ledgers, and a concept known as fractional reserve banking. The process begins with a simple act, a deposit. Imagine a saver, let's call her Anna, depositing $1,000 into her bank account. The bank is legally required to keep only a fraction of that deposit on hand, a safety net known as the reserve requirement. Let's say this requirement is 10%. The bank securely places $100 in its vault, but the remaining $900 doesn't just sit idle. This is where the magic of money creation ignites. The bank now lends this $900 to a small business owner, Ben, who wants to buy new equipment. Ben takes the loan and pays the equipment supplier, who in turn deposits that $900 into their own bank. This second bank now has a new deposit. Following the same rule, it keeps 10%, $90, in reserve and lends out the remaining $810 to another borrower. This cycle of depositing, reserving, and lending continues, with each new loan creating new money that previously did not exist. Anna's initial $1,000 has now supported multiple transactions, effectively expanding the total money supply in the economy far beyond the original physical currency. The money isn't just being passed around, it's being multiplied at each step through the act of lending. Of course, this powerful engine of creation is not left to run on its own. Overseeing this entire system is a central authority, the central bank. This institution acts as the master controller, wielding powerful tools to regulate the speed and scale of money creation. By adjusting key levers, it can influence the entire economy. One such lever is the interest rate. When the central bank raises interest rates, borrowing becomes more expensive, slowing down the cycle of lending and thus contracting the growth of the money supply. Conversely, lowering rates encourages borrowing and accelerates creation. Another critical tool is the reserve requirement itself. By increasing the percentage of deposits that banks must hold in reserve, the central bank limits the amount they can lend, directly reining in the money multiplier effect. In the end, the banking system reveals itself to be a delicate, powerful mechanism, an engine that transforms savings into investment and fuels economic activity. It allows capital to flow to where it's needed most, enabling businesses to grow, families to buy homes, and economies to expand. Yet, this system of money creation, built largely on debt and confidence, also carries inherent risks. Like any powerful engine, it requires careful monitoring and regulation to ensure it runs smoothly, driving prosperity without overheating into a crisis. The flow of money is the lifeblood of our economy, and understanding its origin is the first step toward understanding the forces that shape our world.